Today, we will talk about asset valuation. Asset valuation is the process of determining the fair market or present value of assets, using book values, absolute valuation models like discounted cash flow analysis, option pricing models or comparables. Such assets include investments in marketable securities such as stocks, bonds and options, tangible assets like buildings and equipment, or intangible assets such as brands, patents and trademarks. Asset valuation plays a key role in finance and often consists of both subjective and objective measurements. The value of a company's fixed assets, which are also known as capital assets or property, plant and equipment, are straightforward to value, based on their book values and replacement costs. However, there's no number on the financial statements that tell investors exactly how much a company's brand and intellectual property are worth. Companies can overvalue goodwill in an acquisition, as the valuation of intangible assets is subjective and can be difficult to measure. The net asset value, also known as net tangible assets, is the book value of tangible assets on the balance sheet less intangible assets and liabilities. This is the minimum a company is worth and can provide a useful floor for a company's asset value because it excludes intangible assets. A stock would be considered undervalued if its market value were below book value, which means the stock is trading at a deep discount to book value per share. However, the market value for an asset is likely to differ significantly from book value, or shareholders' equity, which is based on historical cost. Absolute value models value assets based only on the characteristics of that asset. These models are known as discounted cash flow models, and value assets like stocks, bonds and real estate, based on their future cash flows and the opportunity cost of capital. Relative valuation models determine the value based on the observation of market prices of similar assets. For example, one way of determining the value of a property is to compare it with similar properties in the same area. Likewise, investors use the price multiples comparable public companies trade at to get an idea of relative market valuations. Here are 4 key takeaways. 1. Asset valuation is the process of determining the fair market value of an asset. 2. Net asset value is the book value of tangible assets, less intangible assets and liabilities. 3. Absolute value models value assets based only on the characteristics of that asset, such as discounted dividend, discounted free cash flow, residential income and discounted asset models. 4. Relative valuation ratios, such as the P/E ratio, help investors determine asset valuation by comparing similar assets. Hope this would help. Thanks for watching.